Very good evening to all of you. Today we will learn about the bond valuation. As we know that we have two resources in the capital market for long term. That is bond, that is you can say debt security and owner security. In debt security we have three options. Either there is a bond issued by the government, debenture issued by the private sector, and loan from bank. And owner's capital, there are two options. One is equity shareholder, which is known as common stock, and other one is preferred share capital, that is preferred stock. So we want to learn about the bond valuation right now. So it means we want to learn the debt valuation, debt security valuation. So bond or debenture akin to promissory note and is an instrument of debt security by a business or a government unit. That is either by the private sector or public sector. The three basic elements in terms of which a bond is described, that is, one is par value, other one is interest rate, and third one is maturity period. Par value means you can say par value or face value. So par value or face value of bond is the value stated on the face of the bond. It represents the amount that the firm borrows and promises to repay at the time of maturity. Usually, the par or face value of bonds issued by the business is 100 rupees, sometimes 1000. Now, second basic term is interest rate. The bond carries a specific interest rate that is also called coupon rate. The annual interest receivable by the bondholder is simply equal to the par value of the bond multiplied by interest rate. Third one is maturity period. Typically, corporate bonds have a maturity period of 7 to 9 years, whereas government bonds have a maturity of 10 to 20 years. At the time of maturity, the par or face value plus a nominal premium is payable to the bond holder. Is that clear? There are three terms. One is par value, second one is interest rate, and third one is maturity period. Now, how we value the bond? To understand how a bond may be valued, let us consider a debenture of 100 face value that carries an interest rate of 14% and which is redeemable after 5 years at a premium of 5%. Means the face value is 100, means at the time of maturity you will get 100. Interest rate is 14%, and the bond is redeemable after 5 years at a premium of 105, that is 5% premium, means 5% extra you will get. If you own this debenture, how much will you get? So first year because rate of interest is 14%. The face value is 100 rupees. So how much first year we will get? Face value, that is par value multiplied by rate of interest. Rate of interest is 14%, so 14% of 100 is 14 rupees. Second year again 14, third year again 14, fourth year again 14, fifth year again 14, and fifth year is what? Fifth year the bond is redeemable at 5% premium. Means you will not get 100 rupees. 100 rupees you will get at the same time 5%, means 5 rupees more you will get. That is 100 rupees plus 5% premium, that is 5% of 100 is 5 rupees, so 105 you will get. Is that clear? So if you require a rate of return 16% from this debenture, the present value of it is how much? Suppose the required rate of return is 16%. The maturity value is 100 rupees. So how much should be the present value of this bond? More or less, that we will analyze later on. This we will calculate as present value is equal to interest multiplied by present value interest factor annuity. Because why? Because I already discussed you in my previous lectures, that is there are two terms, annuity and perpetuity. Annuity means when you will get the equal amount for a specified number of years at constant rate of interest. So rate is constant 14%. Year time period is specified 5 years. Amount is also specified, that is 14 rupees. 14 rupees, 5 years. So this is the case of annuity. So that is the reason why here you will have to see the factor table of annuity. There are two tables. One is factor table annuity and one is normal table. So because you are getting 14% interest for 5 years, so every year 14 rupees you will get. That is the reason this is the case of annuity, and that is the reason you have written present value interest factor annuity KD, that is required rate of return is 16%, and N is 5 years. Plus at the time of maturity, that is maturity value. Maturity value is how much? 5% premium you are getting. So 105 multiplied by this 105, this 5% premium you are not getting every year. After 5 years, when the bond will be redeemed, so here you will not write annuity because you are not getting this 5%, that is 505 years every year. Only once in 5 years you will get 105 rupees. So maturity value, that is 105 multiplied by present value interest factor KD and N. So present value interest factor, that is you can say discounted factor. So 105 multiplied by, you will see present value interest factor KDN, that is 16% 5 years, the value will be 0.476. And when you will see the factor table of annuity, present value annuity table, 16% 5 years, the factor will be 3.274. So this factor, when you multiply it by 14 plus 0.476 multiplied by 105, the value will be 95 rupees 80 paisa. It means the present value is 95 rupees 80 paisa, and you will get after 5 years how much? 100 rupees or 5% premium. So this is the calculation if this type of question will come. In general term, the value of the bond, how you will calculate, that is present value will be I multiplied by present value interest factor annuity K, that is KD, and N plus maturity value, that is F, multiplied by discounted factor discounted factor, that is present value interest factor, not annuity, K and N. So I, you have written 14, present value and interest factor annuity, K 16% and 5 years, F, that is face value, that is 105, multiplied by discounted factor, that is 16% and 5 years, and that this is not annuity, this is normal table, and normal table you have seen 0.45476, and present value and annuity you have seen factor is 3.274. These are the two factor table which you will have to watch, which you will have to observe to calculate this question. So how you calculate the value of bond? Value bond is annual interest payable. Annual interest payable is 14%, that is 14 rupees, multiplied by present value and annuity factor, this interest factor multiplied by annuity factor, plus redemption value. Redemption redeemable is how much? 105, multiplied by discounted factor. That is all. In this way you calculate the value of the bond. Now come to bond price theory. So with the help of this result which we have calculated, you got some inferences. So based on the above bond valuation model, we will get some result, and we can establish what? When the required rate of return is higher or lower. So how much you have seen in the previous example? Required rate of return was 16%, and interest rate is how much? 14%. Means requirement, your expectation is 16, but you are getting 14. So you are getting 14, means the coupon rate, that is interest rate, is lower than the required rate of return, then the value of the bond will be lower. So let's see here. When the required rate of return is lesser than the coupon rate, the value of the bond is greater than its par value. Is that clear? When the required rate of return is lesser than the coupon rate. When your expectation is less and you will get interest more, then what happens? The value of the bond will be greater than its par value. When the required rate of return is equal to the coupon rate, means whatever you are expecting and the interest, both are same. Required rate of return is also 16% and your coupon rate is also 16%. Then what happens? The value of the bond is equal to its par value. In previous example, what we have seen? Required rate of return was higher. Is that clear? 16%. And interest rate was 14%. So what we have seen? And face value is how much? 100 rupees. But was the value of the bond? 95 rupees. So your value of the bond is lesser than the face value when the required rate of return is higher than the coupon rate. But when the required rate of return is not higher, lesser than the coupon rate, just reverse is true. Then what happens? Your face value will be lesser than the value of the bond. When the value of the bond will be more than your face value. So, but when the required rate of return and the coupon rate both are same, when both are same, there's no problem. Then the required rate of the face value and the value of the bond Both are equal. You just check. Instead of 16, you write 14%. Then you check. The value, instead of 95 rupees 80 paisa, which you have calculated previous example, 95 rupees 80 paisa, you will get 100 rupees. Means maturity is suppose 100, you will get 100 rupees. So here is what? Here your value of the bond will be, present value is 95 rupees 80 paisa. And the maturity value is how much? 100 rupees. So maturity value is higher and your present value is lower. Why? Because required rate of return is higher. But if reverse, if the required rate of return is lower than the coupon rate, then what happens? This value, present value, will be higher and the maturity value will be lower. And the both of them are equal then. If the required rate of return and coupon rate both are same, then the present value and the future value both are same. Means face value, par value and the value of the bond both will be the same. So this is the result from the previous questions which we have observed. So first one is less. Required rate of return is less than the coupon rate. The value of the bond will be greater. When the required rate of return is equal to the coupon rate, value of the bond is equal to its par value. Par value means future value. When the required rate of return is greater than the coupon rate, then the value of the bond, just now we have calculated, will be lesser than the future value, that is maturity value. So as the maturity dates of the bond approaches, the value of the bond converges to its par value. If suppose 5 years is the maturity period, so after 4 years, after 1 year, 2 year, 3rd year, 4th year, but when you are very near to approaching to 5 year, then what happened? The value of the bond will be equal to the maturity value, converges to maturity value, that is par value. And so the longer the maturity period of bond, if the maturity period will, if suppose very longer, then the greater does its price changes in response to a given changes in the interest rate. So the greater you will find the changes in price in response to a given change in the interest rate. So this is about the bond theorem. Now come to bond value with semi-annual. Right now we have discussed about the annual. Now come to the bond value with semi-annual interest rate. Annual interest means what? At the end of the year you will get the interest. Suppose 4% annual interest rate means 14% annual interest rate. It means you will get interest at the rate of 14% once only at the end of the year. But if I say annual rate of interest is 14%, but payable semi-annual, it means what? 14% if annual, then 14 divided by 2, because semi-annual, it means 7%. After 6 months you will get 7%, and again 7% again after 6 months, and 7% plus 7%, 14% you will get. Suppose the rate of interest is, annual rate of interest is 20%. Then semi-annual is how much? 10%. After 6 months, 10%, thereafter again 10%. But if quarterly, then what happened? Then 5%. That is 20 divided by 4. because in 1 month there are 4 quarters. So 20 divided by 4, that is 5%. First 3 months, thereafter again after 3 months 4%, thereafter again 3 months 4%, thereafter again 3 months 4%. 3 plus 3 plus 3 plus 3, 5 plus 5 plus 5 plus 5, 20%. If there is 12%, so 12% divided by 4, that is 3. 16%, 4. Is that clear? Now, so when semi-valuation situation is there, then what happened? So most of the bonds pays interest semi-annually. To value such bonds, we have to work with a unit period of 6 months and not 1 year. This means that the bond valuation equation has to be modified along the following lines. What is that? The annual interest must have divided by 2, just now I discussed you, to obtain the semi-annual interest payment. But if suppose it is quarterly, then what happened? Annual interest rate must be divided by 4 to obtain quarterly annual interest payment. But here semi-annual, so divided by 2. The number of years to maturity must be multiplied by 2. So interest divided by 2 and maturity period multiplied by 2. In quarterly, interest rate divided by 4, maturity period multiplied by 4. If the maturity period is 5 years, then 5 multiplied by 4. 5 multiplied by 2. 5 multiplied by 1. When 1? When annual interest is payable then. But semi-annual, 5 multiplied by 2. Quarterly, 5 multiplied by 4. Is that clear? So the number of years to maturity must be multiplied by here 2 to get the number of half yearly periods. The discount rate has to be divided by 2. If there is discount rate, divided by 2 to get the discount rate applicable to half year periods. That is, suppose 14%, 14 divided by 2. 12%, 12 divided by 2. 20%, 20 divided by 2. So how you calculate the value of the bond? Value of the bond here is I over 2. Why? In previously you have seen I only. Why? Annual interest. So I divided by 1. 1 is, by default there is 1. But here, earlier what happened? 14% annual interest. So 14 divided by 1. Because once only one time you will get 14%. But here semi-annual 14% divided by 2, that is I divided by 2, multiplied by previously present value interest factor annuity K and N. K is discounted factor 16, 16 divided by 1, to 16%. Here 16% divided by 2, that is 8%. There is N multiplied by 1. That is 5 multiplied by 1. Here 5 multiplied by 2 plus face value. Face value is suppose 105 multiplied by discounted factor KD, again 16% divided by 2, K divided by 2, N multiplied by 2. Is that clear? Now you take the example, one example. Suppose consider par value is 100 rupees. Annual interest rate is 12%. Payable semi-annually. Maturity period is 8 years. Required rate of return is 7% for 6 months. That is semi-annual, 6 months, 7%. What is the value of the bond? That is, value of the bond is I is how much? 12% divided by semi-annual divided by 2 multiplied by present value annuity factor. KD is how much? 14%. That is semi-annual. It is 7% for 6 months, means 14% divided by 2 multiplied by N is how much? N is 8 years multiplied by semi-annual, so multiplied by 2 plus face value. Face value is how much? 100 multiplied by discounted factor. How much? 14% divided by 2 N 8 years multiplied by 2. So 12% divided by 2 semi-annual is 6%. 14% divided by 2 discounted factor 7%. And because semi-annual and maturity is 8 years, so 16 years. Discounted factor again 7% and 16 years. When you see the annuity factor table, 7% and 6 years, 16 years, the factor we will get 9.447 plus face value is 100 multiplied by factors. You see the factor table, normal factor table, 7% 16 years, you will get the factor 0.388. When you add both the factors multiplied by the here interest rate, here multiplied by face value, the value of the bond will be 95.50. What is the maturity period? Maturity value 100 rupees. Why? Because required rate of return is how much? 14%. Coupon rate is how much? 12%. Means requirement is 14, you are getting 10 net 12, so obviously the value will be less. So present value will be 95 rupees 50 paisa and your maturity value will be 100 rupees. Is that clear? Now come to next point. Next point you will get, that is types of return, that is types of yield. So there are so many types. The term rate of return, or you can say yield, are mostly used interchangeably, and we will follow the same practice here also. Return is the amount or rate of product, proceeds, gain, fruits, profit, which accrues on an economic agent from an undertaking or enterprise or real or financial investment. So this is, if you will invest your money, either the enterprise or the financial institutions or issuer of the bond will give you the return. Is that clear? So it is a reward. Why? Because you save your money, you have deposited, you have given that amount to that issuer, and because you are investing your money, so he will give you a reward. So it is a reward and a motivating force behind the investment, the objective of which is usually to maximize return. Because bank is asking you to save money. Bank is asking you that, okay, you give me your money is secured, and in addition to this I will give you some reward. That is, I will give you some additional money on your investment. And what is that? That is called premium. What is that? That is called reward. Is that clear? So return on a typical investment has two components. The basic one, which is the periodic costs, periodic cash, or income receipt, either interest or dividend, and the other which is the appreciation or depreciation in the price or value of the asset, called the capital gain or the capital loss. Is that clear? So, periodic cash means what? That is either in the form of interest or dividend. Another one, appreciation or depreciation in the price or value of the assets. What is that called? If the value, whatever, suppose you have invested your money in stock, in debenture, and the value of the bond will appreciate, and the value of the bond may be depreciate. So this is also another type, that is appreciation. When the value of the bond increases, that is appreciation. When the value of the bond decreases, there is depreciation. In what? Depreciation in your asset, the value of an asset. The capital gain or loss is the difference between the purchase price of the asset and the price at which it can be sold. Means you purchase the bond or debentures in 100 rupees and you sell maybe at 90. Then what is? There is a loss. If you sell at 105, then what is that? There is a gain, appreciation. So the value of the asset may be appreciating, may be depreciating. The income component is usually, but not necessarily, received in cash. So what is that? If you will not receive in cash, then what you receive? That is stock. That is stock dividend. So the total return on the investment, this can be defined as income plus or minus price appreciation or depreciation. Is that clear? Now come to IRR, that is yield rate, internal rate of return, which is also known as average internal rate of return, is the rate of discount which makes the present value of all the revenues from the investment equal to the total cost of that investment. It means total inflow and outflow will be equal. It means in IRR, net present value will be 0. You will not get more. Whatever you have invested, that amount only you will receive. Okay? This is known as yield or yield rate. The margin is the rate of discount which makes the present value of the marginal revenue from investment equal to unity. That is, inflow minus outflow will be equal to 0. Net present value will be 0. Is that clear? So, now what is bond rate or coupon rate? It is the interest rate received on the face value or the par value of the bond. As we have already discussed, if a company or the government issues 10 years bond with 100 rupees as face value and 15% rate of interest, it would be described as 15% bond or debenture, and it would be said to have a coupon of bond rate of 15%. So that bond rate is 15%. Why? Because rate of interest is 15%. So bond rate is 15%. Now, realized and expected return. What is this? Return is not as simple a concept as it appears to be. Because it is not guaranteed. Because it is expected. You are expecting. It is mostly expected. And it may or may not be realized. So, expected return is an anticipated, predicted, desired, ex ante return, which is subject to uncertainty. You are only anticipating, you are only predicting. That is the reason why the name is expected return. And realized return? Realized return is, on the other hand, is the actual return which you are earning. It is an ex post return. Or expected is ex ante return. This is the difference. Expected return is ex ante return, that is predicted, anticipated, and realized is which you have already realized, that is ex post return. Now come to holding period return, that is holding period yield, HPR. Very easy. Holding period return measures the total return from an investment during a given period of time in which the asset is held by the investor. It is to be noted that holding period return does not mean that the security is actually sold and the gain or loss is actually realized by the investor. The concept of holding period return is applicable whether one is measuring the realized return or estimating the future return, as holding period return is any cash payment received plus price changes over the holding period divided by price at which the asset is purchased. In most simple way you can say ending price of the asset. Ending price means the price at which you will sell minus the beginning price of the asset, that is the price at which you purchase. Suppose you purchase sell some assets at 50 and purchase at 40. It means price change over the holding. You hold this asset for 1 year. So during this 1 year, the price of the asset changes from 40 to 50, and you sold at 50, you purchased at 40. So 50 minus 40, price changes over the holding period plus any cash payment. And during this period, suppose if the investor, if the company organization is paying you dividend of 5 rupees, then 10 plus 5 divided by beginning price. Beginning price is how much? 40. So in this way you calculate the holding period yield or holding period return. Clear? So the concept of holding period return has been developed from that of holding period return in order to take care of certain needs such as calculating the compound rate of interest or return or geometric mean where negative numbers cannot be used. So holding period return is equal to holding period yield plus 1. If the holding period yield is 20% and holding period return will be 1.20. And if holding period yield is minus 0.25%, then holding period return will be 0.75. Holding period return is always greater than 0, thereby eliminating negative numbers. Now come to types of yield. Number 1 is basic yield. Basic yield is lowest yield actually attained in the market by high grade bonds of a given maturity and class. As we know, that high grade bonds never give you high yield, always give you low yield, because the money is very much secured. So why the branded company will give you more yield? Never. So basic yield is the lowest yield actually attained in the market by high grade bonds on a given maturity and class. This concept can be understood better by noting the concept of pure rate of interest, which is unique and absolutely riskless. It implies absolutely safety and certainty of principals and income. So certainly, because the company is very much branded, your money, your principal and interest both are safe. So that is the reason why yield is very low. And also freedom from losses through changes in commodity prices, interest rates and taxes. You are free. You will not get any loss. Uniqueness implies a single fundamental rate underlying the entire structure of interest rates. The basic yield, however, does not imply either risklessness or uniqueness. Its distinguishing features is that it is on the highest quality bonds. Now come to current yield. Current yield, yield to YTM, yield to maturity is not the same as the current yield. Current yield is the annual interest divided by the bond's current value. Annual interest divided by the bond's current value. As for example, annual interest is 60 rupees on the current investment of 883.40 paisa. Therefore, current rate of return or current yield is how much? 60 over 883.40, that is 6.8%. Is that clear? So, annual interest is 60 rupees. Investment is 883.40. So, current yield is how much? Current yield is 6.80. That is 60 over 883.40. That is 6.8. Current yield considers only the annual interest. 60 is an example and does not account for the capital gain or loss. On maturity, the interest, the bond price will increase to 1000 and therefore will be a capital gain of how much? 116.60, that is 883.40 plus 116.60 will be equal to 1000. You purchase the bond at 883.40 and your interest you will get 60 rupees. Then what should be the maturity value? Maturity value is 1000. So how much capital gain you will get? 1000 minus 883.40, that is 116.40. Is that clear? Thus, the bond overall rate of return over 5 years period would be more than the current yield. If the bond's current price were less than its maturity value, bond's current price is less than its maturity value, means if the maturity value is suppose 700 and in the bond price if suppose 883.40, then what? Its overall rate of return would be lesser than the current yield. Is that clear? So the overall rate of return would be less than the current yield. Current yield in the previous example, current yield was how much? 6.8%. Here in previous example is how much? Your face value is higher and your current investment is lower. Here if the bonds it says if the bond's current price will be lesser. than its maturity value. Current price is lesser than its maturity value. In the above example, current price is lesser and maturity value is higher. Then overall rate of return would be lesser than the current yield. Is that clear? Now, current yield is a ratio of stated, that is coupon interest rate per year to the current market price of the bond. It does not take into account the return to be realized by the investor because of the appreciation in the value of the bond. It is also known as the market yield or the running yield or income yield. Now come to redemption yield or yield to maturity. So yield to maturity, how you calculate the yield to maturity? Very easy also. Suppose the market price of 100 rupees par value carrying a coupon rate of 15% and maturity period of 15 years is 89 rupees. Is that clear? The market price is how much? 89 rupees. Par value is how much? That is face value is how much? 100 rupees. Maturity period is how much? 15 years. And coupon rate is how much? 15%. So, what you have to calculate? Rate of return. How much rate of return the investors earn if he buys this bond and hold it till its maturity. If the investors buy this bond at the rate of 89, the par value of which is 100, maturity period is 15, and the coupon rate is 15%. And the investors hold this bond till its maturity. Then how much will be the rate of return that he earns? And the rate of return that he earns if he hold the bond till maturity, that is called yield to maturity. That is YTM. Is that clear? So, how you calculate? Maturity value is 100. That is future value. Maturity value, you can say future value. Future value is equal to what? That is interest I multiplied by present value, annuity factor, KD, K and N is equal to 5 years plus 100 maturity value multiplied by discounted factors 5 years, K and N is equal to 5 years. So we have to find out the value of K, that is rate of return, that satisfies the above equation. We may find to try several values of K till it hits the right value with a discount factor of 18%. Putting a value of 18% of K, we find that the right hand value of the above equation becomes equal. That is 15 multiplied by the annuity value will be 3.127 plus 100 multiplied by discounted factor will be 0.437 will be equal to 90.605. And how much you have invested? 89 rupees. And what will be the future value? Required rate of return? That is 90.605. As this value is more than 89, because investment is par value is 100, that is face value is 100, and your how much you have invested? 89 rupees, and required rate of return, the value is how much? More than 89. Why? Because required rate of return. So we try a value of k. Let's try at the rate of 19. This makes right hand side equal to 87.77. So when we try with 19%, then at 19% discounted factor, we'll get 15 multiplied by 3.057 plus 100 multiplied by 0.419, and that will be equal to 87.77. It means what? It means your yield to maturity will be this k, that is rate of return, lies between 18% and 19%. At 18%, how much it will be? It will be 90 rupees. Because we have considered required rate of return 19%. So at 19%, your amount is 90 rupees. And how much you have invested? You have invested 89 rupees. So this value is more than 89. And when we try at the rate of 19, the value will be less, 87.77. Means at 19%, this value is lesser than your 89. It means your rate of return should be neither 18 nor 19. It means this K, rate of return, lies in between 18 and 19%. Is that clear? So if we calculate exactly how much it will be, so with linear interpolation, then how much you will get? Very easy. 18% is okay. 18 point something percent in between 18 and 19. How much? 18 point how much? For this point, you calculate 18% final plus the difference between these two, that is 19% and 18%, that is 1%, multiplied by the discounted values at 19%. Discounted values at 19% is how much? Discounted value at 19% will be 18% will be 19.605 minus the purchase price 89 rupees. So the value at 18%, the difference between the values and the purchase price at 18% divided by the values, difference in the values at 19%, that is 19%, how much you have calculated? 90.065 minus 87.77. So, is that clear? That is difference between 19% and 18% multiplied by the values you will get at 18%. The values we will get at how much? 19 at 18%, 90.605, which is higher than 89 rupees. So 19 difference between 19.605 minus 89 rupees over the difference in the values at 19%. So how much? 19.605 minus 87.77 means the difference in the value in between 19% and 18%. So 19%, 87.77, 18%, 90.605. So difference between this amount, that if you calculate this, the amount you will get, that is 18.57. Means at 18.57, your value will be equal to the value which you have invested, that is 89 rupees, and 18.57 if you calculate, that will come at 89 rupees only. So this is what called yield to maturity, that is redemption yield. Is that clear? So how you calculate this redemption yield? That is annual redemption present interest. So in this way you should calculate the redemption yield to maturity. Now if we calculate another questions, like if the market price is suppose 89 rupees, redemption value of 100 rupees, annual interest is 15 rupees, and yield to maturity 5 years. Then how you calculate yield to maturity? Market price 89, redemption is 100, annual is interest rate is 15 rupees, yield to maturity 5 years. So you have to calculate the yield to maturity of the bond, YTM. How you calculate? Very easy. Yield to maturity is how much? That is annual interest is 15% plus redemption value 100 rupees, that is maturity value, minus purchase value, how much? 89, over maturity period, how much? 5 years, over 0.4 multiplied by redemption value. Redemption value is how much? 100 rupees, plus 0.6 multiplied by present market value. 0.6 multiplied present value is how much? 89 rupees. And in this way you calculate yield to maturity is how much? 18.42%. So 18.42%, this is your yield to maturity. Clear? Now come to another question. So in this way I have discussed so many questions, yield to maturity. Now realized yield to maturity. How you calculate a realized yield to maturity? Again the same way you calculate like this also. This is a big question. If you go through, you will get. That is, here the par value is 1000, carrying interest rate is 15%, payable annually, not semi-annually, annually. Maturity period is 5 years. The present market price of this bond is 850 rupees. Reinvestment rate applicable to the future value is 16%. The future values of the benefit receivable from this bond, that is 2032 rupees. So what is the realized yield to maturity? You have to calculate. So investment is 850. Reinvestment period in years how much? It says 15%. 15% of what? 15% is of par value. Par value is how much? 1000 rupees. So 15% of 1000 is how much? 150. So 150 you will get interest every year for 5 years. No problem. Coupon factor is how much? Coupon factor is 16%. that is written, the reinvestment rate applicable to the future value, future cash flow of this bond is 16%. So compound factor 16%, future value of intermediate cash flow. So 16%, how much? That is 4 year. 0 year you will not get. 16%, 4 year, 3 year, 2 year, 1 year, 0. When you calculate this intermediate cash flow maturity, that will be equal to 1.81, 1.56, 1.35, 1.16 and 1. And when you add all this, the amount will be 271.5, 234.0, 202.5, 174 and 150 rupees. And at the end of 5th year, you will get the maturity par value, that is 100,000 rupees. So when you add all this, then 275 plus 234 plus 202 plus 174 plus 150 plus 1000, and the amount we will get is how much? 2032 rupees. How you calculate? With the help of formula. Formula you will calculate present value market, present market price multiplied by 1 plus R to the power 5 is equal to future value. Present market price is how much? 850. 1 plus R to the power 5 is equal to future value is how much? 2032. So 1 plus R to the power 5 is how much? That is 2850 multiplied by 1 plus R to the power 5 is equal to 2032. So 1 plus R to the power 5 is equal to 2032 divided by 850 is equal to 2.391. So realize yield to maturity is how much? R is equal to how much? R will be equal to root under 2.391 will be equal to 19.19 and is equal to 19%. So realized yield to maturity is 19%. Now come to yield to call. Yield to call is number of companies issued bond with buyback or call provision. This bond can be redeemed or called before maturity. What is the yield or rate of return of a bond that may be redeemed before maturity? The procedure for calculating the yield to call is the same as for the yield to maturity. So yield to call and yield to maturity, the calculation will be the same. The call period would be different from the maturity period, and the call value could be different from the maturity value. If you call for money before maturity, obviously the maturity value and the call value will not be the same. Take the example. Suppose for 10%, 10 years, 1000 bond is redeemable in 5 years. Maturity is 10 years, but redeemable after 5 years. As a call price of 1050. The bond is currently selling for 950. Currently the bond, if suppose you purchase at the rate of 950. The maturity face par value is 1000. Interest rate, coupon rate is 10%. And maturity period is 10 years. But after 5 years, maybe the bond is redeemable or callable as a call price of 1050. What is the bond's yield to call? How you calculate? Easy. Just like yield to maturity. Instead of 800, how much you have taken? You have taken here, that is 833, or here you take 883.40. Here you take as 940, 950, because yield to maturity, if, this is how much the current you purchase the current bond selling at the rate of 950. So 950 present value is equal to interest how much? 10% of 1000, that is 100 rupees. 100 divided by 1 plus yield to call, plus maturity value is how much? After 5 years callable, 1050 divided by 1 plus yield to call. When we calculate this one, then 950 is equal to 100 divided by 1 plus yield to call plus 1050 divided by yield to call to the power 10. The yield to maturity will be 11.3%. If the bond is redeemable at par on maturity, if the bond is redeemable at par at maturity, then the yield to maturity will be 10.9%. But before this, the yield to maturity will be 11.3%. Is that clear? So now come to next part, that is bond value and amortization of principal. The bond may be amortized every year. That is repayment of principal every year, rather at maturity. Means after every year you will get the principal. So this type of thing is known as amortization. In that case, the principal will decline with annual payment, and interest rate will be calculated on the outstanding amount. The cash flow of the bond will be uneven, not even. As for example, value of bond when principal is amortized every year. Suppose a government is proposing to sell a 5 years bond of 1000 rupees at 8% rate of interest per annum. The bond amount will be amortized equally over its lifetime. If an investor has a minimum required rate of return is 7%, what is the bond's present value of the firm? For the investor, what is the present value of the bond? Amount of interest will go on reducing, because the outstanding amount of bond will be decreasing due to amortization. The amount of interest for 5 years will be, that is how much interest you have to find, that is government is paying you 8% rate of interest. So first year 1000, 8% of 1000, that is 80 rupees for the first year. So 1000, 80 rupees, 1000 minus how much? Equal means for 5 years 1000 is your maturity value. So equal is paying every year. So 200, 1000 divided by 5, that is 200. So out of 1000, 200 you will get. So out of 1000, 200 you will get, multiplied by 8%. So 800, 8% of 800, 8% of 800, how much you will get interest? 64 rupees. So first year you will get 80, because 8% of 1000, that is 80. Second year 1000 minus 200, that is 800 multiplied by 80%, that is 64%, 64 rupees for second year. Third year 800 minus 200, that is 600 multiplied by 8%, that is 48 rupees. Fourth year, 600 minus 200, that is 400, multiplied by 8%, that is 32 rupees for fourth year. Fifth year, 400 minus 200, multiplied by 8%, that is 16 rupees. And the end of how much? End year, at the outstanding amount of the bond will be 0 at the end of fifth year, because every year you will, second year 200, third year 200, fourth year 200, fifth year 200. Every year you have received, amount has been decreased. Second year 200, that is 800, third year 200, 600, fourth year 200, 400, fifth year 200, 200, and last one is fifth year you received 200. So last amount you received at the end of fifth year. So total amount you have received. So this is what called the amortization of the bond. If the period is 5, then 1000 divided by 5, that is 200 every year you will get, and the rate of interest amount also will decrease. First year 8% of 1000, second year 8% of 800, third year 8% of 600, fourth year 8% of fourth year, and fifth year 8% of 200. So total amount you will get. Is that clear? So since the government will have to return 200 every year, the outflow every year will consist of interest payment and repayment of principal, that is 200 plus 80, 280, 200 plus 64, 264, 200 plus 48, 248, 200 plus 32, 232, and 200 plus 16, 216 respectively, from first through fifth year. So referring to the present value table, the value of the bond you calculate as B0 is equal to 280 plus 264 plus 248 plus 232 plus 261 over 1.07 to the power 1, 1.07 to the power 2 to the power 3 to the power 4 to the power 5. And the amount you will get, how much? Your amount will be bond, the value of the bond will be 1025.66, 1025.66 paisa. So the formula for determining the value of the bond or debenture that is amortized every year, you have to write this, that is B0 is equal to CF1 plus CF1 divided by 1 plus KD over 1, CF2 to the power 2, CF3 to the power 3, CFN to the power K plus KD to the power N. That is summation of CFT over 1 plus KD to the power T, where T is equal to 1, and how many years? N number of years. Is that clear? So this way you calculate this bond. Clear? This is second question, third question. The same type of questions you can calculate easily. I have given you so many things. So next, in the next class we will discuss the perpetual bond. So all this annuity bond we have discussed. Next class we will discuss perpetual bond. So thank you very much. So bond valuation, we have discussed so many class of types of bond, and the way you calculate yield to maturity, bond value, and so many annual, semi-annual. So all this bond valuation we have calculated. Next class we will discuss perpetual bond, and thereafter we will discuss the equity valuation as well as the total equity valuation. Thank you very much. So again, stay at home, keep safe, because there is no option. Thank you very much. Good night. I don't know.